Welcome to the Opening Bell Report.
Imagine for a second that you are sitting at your desk, right?
Okay.
You're scanning through a company's Q4 2025 earnings report.
Fun Tuesday morning.
Yeah, exactly.
Yeah.
And the number staring back at you is a net loss of $1.7 billion.
Wow, with a B.
With a B. I mean, for almost any traditional business on Earth, posting a $1.7 billion quarterly loss would be...
It's an existential crisis.
Literally. You would naturally expect the stock to just absolutely crater the second the market absorbed that information.
Oh, yeah. Usually a massive sell-off.
Right. But instead, you glance over the after-hours trading ticker, and the stock hasn't plummeted at all. In fact, it has surged. It's up somewhere between 15 and 18%.
Which on the surface feels like a complete glitch in the matrix.
It really does. How does a billion-dollar hole in the balance sheet trigger a buying spree?
It's one of those really specific financial moments that kind of forces you to step back and look at the mechanics of how markets actually process information. Because it seems entirely counterintuitive if you're only looking at the top line numbers.
Right, the $1.7 billion.
Exactly.
Oh.
But markets, fundamentally, are forward-looking machines. They are way less concerned with what happened yesterday and heavily focused on the structural reality of tomorrow.
Okay, let's unpack this.
Yeah.
Because that structural reality is exactly what we are exploring today.
Let's do it.
We have our hands on a really fascinating recent analysis report that breaks down this exact scenario.
And the company at the center of all this is MAR.
Yes, MARA. And our mission for this deep dive is to explore the intricacies of a massive transformational pivot they are making.
Right.
We're going to examine their new Starwood joint venture in detail. To answer this really compelling question floating around the market right now, is MARA the next big AI stock?
Which is wild to think about.
It is. Because they are actively transitioning from being known almost exclusively as a pure-play Bitcoin miner into positioning themselves as an absolute heavyweight in the artificial intelligence and high-performance computing infrastructure space.
And, you know, that transition is precisely why Wall Street is completely looking past that Q4 net loss.
They just don't care about it.
Not at all. Because the past, in this specific case, doesn't represent the future cash flow profile of the company anymore.
Right.
What investors are rewarding is a fundamental alteration in MRA's entire investment narrative. They just announced this massive new joint venture with Starwood Capital Group.
Starwood Digital Ventures specifically, right?
Right, exactly. And this partnership signals to the market that MRA has found a highly lucrative, really stable way to monetize what is arguably their most valuable asset.
And crucially for you listening, that asset isn't actually Bitcoin.
No.
It's physical power.
Electricity, yes.
That distinction is so important. But before we dive into the Starwood deal itself, we should probably clarify that $1.7 billion loss.
We definitely should.
Because it perfectly illustrates the problem with her old business model.
It really does.
When you look at the data in the analysis report, you realize this wasn't $1.7 billion of cash just flying out the window because of some massive operational failure.
Right, it wasn't cash burn.
It was almost entirely a quirk of accounting reality.
Yeah, JAP accounting rules can be brutal for crypto companies.
Exactly. When the price of Bitcoin drops at the end of a quarter, accounting rules basically force companies holding large amounts of it to record that drop in value as a loss on their official income statement.
Even if they haven't actually sold a single Bitcoin.
Right. So that loss wasn't money leaving their bank account.
No.
It was just the mark-to-market paper value of their digital vault temporarily shrinking.
Precisely. It is a non-cash markdown on the fair value of their treasury. Out of that $1.7 billion, about $1.5 billion was just this paper markdown during a crypto dip.
Which is a huge distinction.
Huge.
Yeah.
But even though it is just on paper, it highlights the extreme volatility of operating as a pure-play miner.
Yeah.
And that volatility absolutely terrifies traditional institutional investors.
All right, the guys managing pensions and endowments.
Exactly. They are looking for stability. They want predictable revenue, which really brings us to the anatomy of this new deal, the actual what of the situation.
Let's get into it.
MARA has partnered with Starwood to aggressively convert their power-rich sites into next-generation AI and hyperscale data centers.
And when we look at the actual footprint of this transition in the report, the scale is what really stands out to me.
It's massive.
The analysis report points out that this joint platform is targeting an initial 1 gigawatt of near-term IT capacity.
Yep.
With a clear pathway to expand beyond 2.5 gigawatts down the line.
Which is hard to even visualize.
It really is. I mean, for anyone outside the energy or infrastructure sectors, a gigawatt can sound a bit abstract.
Just a big sci-fi word.
Right. But in the physical world of data centers, it is a staggering amount of electricity.
To put 1 gigawatt into perspective for you, it is essentially enough power to run a medium-sized city. Or, you know, in the context of this deep dive, It is enough power to run hundreds of thousands of the most advanced, most power-hungry AI GPUs on the market right now.
Hundreds of thousands.
Easily. We are talking about the foundational infrastructure required to train the next generation of massive, large language models.
Which is what everyone is trying to build right now.
Everyone. The major tech companies are absolutely desperate for this level of power. It has become the ultimate bottleneck in the whole AI boom.
Because getting the chips is only half the battle.
Exactly. Anyone with enough capital can buy a fleet of AI chips, assuming you can get off NVIDIA's waitlist.
Right.
But finding a physical location to plug hundreds of thousands of them in,
Keep them cooled.
keep them sufficiently cooled, and keep them running 247 without literally browning out the local electrical grid.
Yeah.
That kind of energized real estate is incredibly rare today.
And securing that energized real estate takes time.
Right.
You can't just build it overnight.
Oh, it takes years.
The report mentions getting grid interconnect approvals from utility companies can take anywhere from 5 to 7 years in some jurisdictions.
And that's if they even approve you at all.
Right. But MRA already went through that headache.
They did.
They bring the hardest asset to acquire in today's tech landscape to this deal, the physical land, with locked-in, large-scale, low-cost power agreements.
They literally have the electricity flowing today.
Yes. And this is where Starwood becomes the absolute perfect missing puzzle piece.
Right, because MRA has the power, but Starwood brings the multi-decade track record in enterprise real estate.
They actually know how to find the enterprise tenants and operate these massive facilities.
Which is a totally different beast than running a warehouse full of Bitcoin mining rigs.
Completely different.
It is a highly complementary division of labor. Starwood brings traditional heavy-hitting institutional capabilities.
Deep pockets.
Very deep pockets, which is essential because building out hyperscale data centers, these massive warehouse-sized facilities custom-built for cloud computing and AI, is incredibly capital-intensive.
Concrete, steel, advanced cooling.
Exactly. And Starwood also brings global real estate expertise. They know how to design these facilities to meet the really exacting standards of Fortune 500 companies.
Right.
They know how to structure the complex lease agreements, and they know how to manage the mission-critical operations day to day.
So MRI understands energy arbitrage and mining hardware, and Starwood understands how to cater to the biggest tech tenants in the world.
Perfect match.
The data we are looking at in the analysis report highlights an operational concept that makes this partnership even more dynamic.
The dual workload.
Yes. Here's where it gets really interesting. These future campuses aren't just going to be gutted and turned entirely over to artificial intelligence.
Right, they aren't abandoning mining.
No, they are being engineered to support both Bitcoin mining and AI compute simultaneously.
And that dual workload design is perhaps the most elegant part of this entire strategy.
It really is.
It addresses the distinct physical realities of both industries because Bitcoin mining operations are relatively rugged.
Yeah, just big fans.
Basically, they use massive air cooling fans, and crucially, they can be powered down in a matter of seconds if the local grid gets too strained.
Or if power gets too expensive.
Exactly. AI data centers, on the other hand, require pristine, climate-controlled environments.
Hospital-level clean.
Yes, often utilizing complex, direct-to-chip liquid cooling systems, and they demand 99.999% uptime.
They cannot go offline.
They absolutely cannot. Housing both on the same campus requires some incredibly sophisticated power routing.
I was actually thinking about it like a hybrid car engine.
Okay.
You know how a hybrid seamlessly switches between using the electric battery and the gas engine, depending on how fast you're driving?
Right.
Or how much torque you need at a specific moment? It optimizes for whatever is most efficient and cost-effective at that exact second. Yeah.
This dual workload setup allows MR to do the exact same thing with their electricity.
That is a perfect analogy for how they are planning to manage their energy load.
Thanks.
It allows MR to dynamically shift their power allocation based on real-time market pricing.
Oh, wow. Real time.
Yeah. So if the price of Bitcoin is suddenly skyrocketing and mining profitability is at an all-time high,
They route more power to the mining rig.
exactly. Conversely, if AI compute demand is peaking, or let's say Bitcoin mining becomes temporarily unprofitable due to a market dip,
They just shift the power priority over to the AI workloads.
right, they are optimizing their daily profitability by essentially trading energy between two completely different high-value tech sectors.
Ensuring that not a single megawatt goes to waste.
Not one.
Which naturally leads us to the core motivation behind all of this, right?
Wait,
The why.
why do this now?
Why make this massive structural pivot right now? Because historically, MR has traded as what financial analysts call a high beta proxy for Bitcoin.
Meaning, if Bitcoin's price goes up 5%, MRA's stock might go up 10 or 15%.
It's a leveraged play.
Exactly. Investors loved using them as a publicly traded vehicle to play the crypto market without actually having to figure out how to buy and store crypto themselves.
Which is great when the market is going up.
Works beautifully in a roaring bull market.
Yeah.
But pure play mining carries some brutal macroeconomic headwinds that you simply cannot ignore over the long term.
It is an incredibly difficult business model to sustain. The primary issue is the programmatic nature of network difficulty.
Right. The algorithm itself.
Exactly. The way the Bitcoin network is fundamentally designed, as more miners come online globally, the network automatically adjusts its algorithm to make it mathematically harder to mine the next block.
It's a self-correcting system.
It is. But what that means for a company like MRA is that it requires exponentially more compute power, and therefore exponentially more electricity, to mine the exact same amount of Bitcoin year over year.
Imagine running a traditional factory where every couple of years, the exact same amount of raw materials automatically requires double the electricity to process.
Just to get the same output.
Simply because competing factories opened up on the other side of the world.
Yeah.
The economics would just crush you.
They really would. And the numbers from the analysis report illustrate this perfectly.
Let's hear them.
In the fourth quarter of 2025, MRA's energy cost to mine just one single Bitcoin surged to over $48,600.
Wow.
And that is just the raw electricity cost. That doesn't include the building, the staff, the security, or the hardware depreciation. Just the power.
Just to keep the lights on and the fans spinning.
Exactly. When your underlying production costs are relentlessly climbing due to network difficulty, but the price of the asset you are producing is highly volatile.
Your revenues are going to swing wildly.
Wildly. You have very little control over your operating margins on a month-to-month basis.
Right.
And that brings us to why the AI infrastructure pivot is the perfect antidote to this volatility. If we connect this to the bigger picture, looking at the broader enterprise tech landscape, the shift to AI colocation completely changes the financial profile of the company.
Right, because the contracts are structured entirely differently than just selling mined Bitcoin on the open market.
Entirely differently.
When we talk about colocation leases, we are talking about MLRA providing the physical space, the cooling, and the guaranteed power, while the tech company brings their own servers.
Yep.
And when you are dealing with enterprise AI clients and massive cloud providers, they don't sign month-to-month agreements.
Oh, no.
They sign ironclad 5 to 15-year colocation leases.
Which is the dream for any infrastructure company. This pivot fundamentally transforms MLRA from being a speculative commodity producer into what the report accurately categorizes as a digital utility company.
A digital utility company. I like that phrase.
It's very accurate. They go from unpredictable, volatile revenue swings tied to the whims of the crypto market to highly stable, predictable, projectable cash flows locked in over a decade.
And it isn't just about stability, right?
The
unit economics are vastly superior.
Oh, much better.
When you are selling guaranteed uptime, heavy-duty liquid cooling infrastructure, and absolute power certainty to an AI company, you can charge a massive premium.
You absolutely can.
The numbers in the report suggest that this yields significantly higher and much more reliable margins per megawatt of power than self-mining Bitcoin ever could in the current environment.
Because those AI companies are more than willing to pay for absolute certainty.
They have to.
Right. Think about the operational differences here. If a Bitcoin miner goes offline for an hour because of a power dip, the company loses an hour of mining revenue?
Right. It's annoying, but you just turn it back on.
Exactly. It isn't catastrophic to the business. However, if an AI company's massive training run, which can take weeks and cost millions of dollars in compute time, if that gets interrupted by a power failure, it can ruin the entire model.
If they lose all that progress.
It forces them to start over, it delays major product launches, it burns millions of dollars.
So they will gladly pay a massive premium to a partner who can guarantee the power will not drop.
Gladly.
That makes perfect sense. The enterprise market demands reliability, and they pay for it.
Yep.
But when you look at how clean this strategy is, it raises an obvious question for me. Are they the first ones to execute this playbook?
They actually aren't.
Yeah, the data points out that there is a fascinating trailblazer in this space that already proved this concept to Wall Street.
Core Scientific?
Core Scientific, which trades under the ticker CORZ.
Core Scientific is the perfect case study for what MRA is attempting here.
Yeah.
They really prove that this business model not only works, but that the broader market will heavily reward it.
The history there is incredible. Core Scientific actually shifted from being a post-bankruptcy miner.
Literally filed for Chapter 11.
Yes. During the crypto winter, they filed for Chapter 11. And they emerged to become an absolute AI darling on Wall Street.
An incredible turnaround.
They managed to emerge from bankruptcy by pivoting their power assets, eventually securing billions of dollars in long-term AI hosting contracts.
Their most notable deal was a massive agreement with a specialized cloud provider called CoreWeave.
CoreWeave, right. And Wall Street's reaction to that was striking. They drastically expanded Core Scientific's valuation multiples, rewarding them immensely for finding a stable, high-margin use for their energy footprint.
And in financial terms, multiple expansion just means investors are suddenly willing to pay a much higher price for every single dollar of earnings the company generates.
Right.
Wall Street will always pay a premium for a dollar of highly predictable, recurring enterprise revenue over a dollar of unpredictable, volatile crypto revenue.
That makes sense.
And that is exactly the re-rating that institutional investors are anticipating with MAI right now.
But while Core Scientific proved the concept the hard way, going through bankruptcy,
Yeah, very hard way.
MAI is entering the space with a unique structural advantage that could allow them to just entirely dominate the competitive landscape.
And that advantage is their war chest.
The war chest. When you look at what is required to build out gigawatts of hyperscale AI infrastructure, you are talking about billions of dollars in capital expenditure.
It's so expensive.
Concrete, steel, industrial cooling systems, substations, none of this is cheap.
No.
For most companies attempting this pivot, they have to go out to the market and raise that money.
Right.
And historically, that means heavily diluting their existing shareholders by issuing massive amounts of new stock,
Or weighing the company down with crushing amounts of high-interest corporate debt.
which kills the stock price anyway.
Exactly. That is the traditional bottleneck for infrastructure expansion. But MRRA is walking into this AI race with a remarkably pristine balance sheet.
The numbers are staggering.
The analysis report lays out their specific assets. They are currently holding roughly $4.7 billion in Bitcoin.
$4.7 billion.
That is 53,822 BTC sitting securely in their treasury right now.
That is wild.
Furthermore, they have over 66 exahashes per second of energized hash rate.
Just to pause on that metric for a second for anyone listening, because it sounds like pure sci-fi terminology.
It does.
An exahash is simply a measure of computational power. Having 66 of them means MRA is currently operating one of the largest, most powerful fleets of computing hardware on planet Earth.
It is a massive scale of operational computing.
It truly is.
And combining that operational scale with their $4.7 billion treasury creates the ultimate strategic buffer.
How so?
Well, they have the ability to leverage Starwood's capital and real estate expertise, obviously.
Right?
But they can also strategically use their own massive Bitcoin holdings to fund these multi-hundred megawatt campus buildouts.
Oh, I see.
They can self-fund a significant portion of their transition to AI infrastructure without destroying shareholder value through heavy dilution.
So they don't have to go beg the market for cash.
Exactly. It is a position of incredible financial strength that most of their competitors simply do not possess.
So bringing all of this data together, so what does this all mean for you, the listener, trying to make sense of this company's trajectory?
Right.
When we weigh the short-term reality against the long-term potential of the Starwood joint venture, how should we process this evolution?
Well, in the short term, the reality is that MRA is still heavily tethered to the broader crypto market.
They still have those 53,000 Bitcoin.
They do. They still hold that massive treasury, and they are still actively mining at an enormous scale.
Right.
So you should fully expect the stock to continue trading with high volatility tied to the daily price movements of Bitcoin.
It's not going to be a straight line up.
Definitely not. Furthermore, building these data centers is a massive physical undertaking.
Shovels in the ground.
It requires intense execution, significant capital deployment, and most importantly, time.
Time.
You do not build a 1 gigawatt hyperscale data center overnight. It is going to take years to get these complex facilities fully online, tenanted, and generating that stable, recurring revenue.
Right. Despite all the high-tech AI terminology we've been using, it is still a massive construction project at the end of the day.
It is.
You still have to pour the concrete and run the heavy-duty copper wire.
Exactly.
But the long-term re-rating potential is exactly what that after-hours market surge was reacting to, isn't it?
Yes, that 15 to 18% bump.
That rally proves that institutional investors believe in the viability of the pivot. They aren't waiting for the buildings to be finished.
No, they are buying into the execution certainty that the Starwood partnership provides.
Right.
By bringing Starwood in, MRA gave the market the pedigree it needed to say, okay, they actually have the operational expertise to pull this off.
And if they do successfully pull it off, if MRA delivers on that targeted 1 gigawatt to 2.5 gigawatts of enterprise AI capacity, the financial profile of the company changes permanently.
Permanently. Its valuation will structurally decouple from the crypto markets.
Meaning they won't just be viewed or valued as a high-risk crypto proxy anymore.
Exactly. Right now, mining companies have their price-to-earnings multiples artificially capped by the sheer volatility of their underlying commodity.
Right.
As we discussed, investors simply won't pay a premium for unpredictable earnings.
No one wants that risk.
But as an elite digital infrastructure asset, providing the physical backbone for the global AI build-out, Mara will start to command premium, tech-like multiples.
It's a completely different league.
It is. They will begin to be valued much more like a high-growth digital utility company or a premier data center REIT, a real estate investment trust that generates steady, high-margin yields from enterprise leases.
It really is a fascinating strategic maneuver when you look at the entirety of the data in this report.
It's brilliant.
We started this deep dive looking at what appeared to be a volatile crypto miner bleeding over $1 billion in paper losses.
Right.
And what we actually uncovered is a company systematically using its massive, incredibly hard-to-replicate power assets to become the stable, high-margin backbone of the entire artificial intelligence revolution. They are taking the most chaotic, unpredictable asset class in the world, crypto mining, and using it to bootstrap the most stable, in-demand infrastructure class in the modern economy.
It is a textbook example of pivoting physical assets to meet shifting macroeconomic demand.
Yeah.
And analyzing this transition actually raises a much broader question about where the true foundational value in the tech sector is ultimately heading.
Ooh, I like where this is going.
This is something for you to mull over long after we wrap up this deep dive.
Let's hear it.
If raw energy and physical access to the power grid are rapidly becoming the ultimate, unavoidable bottlenecks for the entire future of artificial intelligence,
Which they are.
will the infrastructure companies that physically control the power grids and the cooling systems eventually wield more influence and command more value than the tech giants who are merely building the software?
Now, that is a striking thought to leave on. The folks pouring the concrete, securing the land, and running the power lines might just end up owning the gold mine of the AI era.
It's very possible.
Thank you all for joining us on this deep dive into MRA's strategic pivot. Keep questioning the headlines, keep exploring the data beneath the surface, and we will catch you next time.
Take care, everyone. Keep digging into those reports.
Don't forget to like, share, and subscribe for more.